Let's also welcome on board Mr. Sudip Bandyopadhyay, Group Chairman at IndiTrade Capital, joining us. Sudip, before we come to you, just want to take some final thoughts from Mr. Bagga before we let him go. And sir, what's your take on the entire Indian consumption story as of now? Quarter one for staples so far hasn't been all that exciting. Colgate also at a fresh 52-week low in trade today. What's your take on where we are headed in terms of staples as part of FMCG?
I think recovery is coming, maybe another 3 months from now as the October harvest comes in. That will have an impact. Urban consumption has not yet picked up. Rural was already strong, and the monsoon will help it. The good thing is the RBI cutting rates. That has led to more money being available, as EMIs have started coming down. So that's going to an impact. The second is the government, the fiscal stimulus in terms of the tax rate cut on the margin that the government gave, that is bringing in some amount of money, but much more is needed. So we are looking forward to some relief on the GST front, some more fiscal stimulus. The government has, in all its wisdom, always thinks through this on a long-term perspective. So the news flow is that much more spending coming on infrastructure as well. That has already been catching up in the first 5-6 months of this calendar year, and we are expecting more road contracts, more infrastructure spending coming in. That should create a virtuous circle as well. That's more slow than a direct injection, but it's also not inflationary. So it's a well thought out strategy. I think it will work out. So post October, I'm looking at a better consumption number and a recovery in the Indian consumption story also.
Thank you very much, Ajay, for joining us and giving your views on, of course, the global context and the India's consumption story as well. Sudeep, good afternoon. Sharad here. Of course, Ajay was speaking about the India's overall infra space as well, how it's actually interest rate sensitive. And slowly in this interest rate cut scenario, some benefits do happen when it comes to the capital goods space or even the infra space. So how do you see these both spaces actually panning out? We have already seen ABB India, Siemens, Thermax all gaining in trade over the last 4-5 odd sessions as well, as the guidance for the next year in the new age sectors seems strong. So Sudeep, how is it looking like the infra space as well as the capital goods space?
Well, we have been, Sharad, bullish on this space for last almost a year plus. Look, a couple of things are happening in the world. One is there is this entire tariff-related shenanigans which is going on, and that is creating significant amount of uncertainty world over, including in India. And this is one sector, whether you call infra and cap goods, as far as domestic part is concerned, is to a great extent, shielded from the tariff-related challenges and the uncertainties. So if you have to really look at, for lack of better word, Trump-proof sectors in India, these will be one of the sectors which you can look at. The second part of the positive points as far as this segment is concerned is government in their last budget laid out a capital expenditure plan of 11 lakh crore plus. Now that spending has started in the right earnest. And of course, this helps both infrastructure and cap goods sector in a big way. Private capex, while it has been sporadic, there are significant amount of capital expenditure happening as far as power sector is concerned. And again, capital goods sector does get benefit of that in a big way. So considering everything, I think, one can definitely look at this entire space. We have been positive on Larsen and Toubro for a very long time, and we continue to maintain our positive stance even now on Larsen. I think it's a great stock to buy along with the India growth story, India infrastructure spend, India capital goods spend. Whichever you look at it, Larsen probably will be our first pick. ABB, Siemens, BHEL, can all be looked at, but one has to be a little careful about the valuation. And in case of BHEL, actual operational performance, last quarter was fine, but we have to keep an eye on BHEL's operational performance. There is no dearth of order. There is no dearth of, whether the existing order book or future order inflow. But the question is, what valuation you are buying and how is the execution progressing as far as these three companies are concerned.
Okay, the take and the pecking order that Sudip is liking at the point for the entire infra / capital goods space. But while we're talking about the earnings to watch out for, the stocks that could be in focus on the back of that, post-market today, we have Tata Consumer and Infosys. Both of those companies will be coming out in their numbers. For Tata Consumers, we're expecting a mixed quarter coming in, because revenue we expect to go up by about 10.5%, but it's actually the EBITDA and EBITDA margin where we're seeing a little bit of a pressure. Net profit could see a healthy growth of about 22 to 23%, but remember that this time we're expecting the other income segment of PAT to boost the overall profitability. So while prima facie PAT may look healthy, fundamentally this could be the reason why PAT is up if those numbers align with our expectations. Salt is expected to do well. Tea volumes are expected to look healthy. Their recent acquisitions, Organic Foods as Capital Foods as well as Organic India, both of them are expected to do well as well. In terms of where we can see some pressure is a ready to drink portfolio segment on the back of shortened summer. So that's at least the kind of roundup that we're expecting from Tata Consumer, with an overall growth of 6%, healthy number on that front as well. It's going to be important to watch out for the segmental performance as well as the outlook on raw material pricing, any price action, price hikes, how much they've absorbed, how much they've passed on, and also more importantly the outlook on the Starbucks segment of the business is going to be very important to watch out for. So that's on Tata Consumer. And let's also very quickly get a chart check on Tata Consumer from our technical guest on the show. And Shrikant, what's your take on the Tata Consumer charts? If the stocks are in line with our expectations, where do you believe the stock could head next?
See, for Tata Consumer, it is forming some weakness, weak sort of formation on daily and weekly basis. It is not holding above the important levels of 1080, which is something really negative in the short term. So we may see the levels of maybe 1000, 1010 on the downside. But broadly, I am of the view that the overall long-term pattern of the stock is bullish. And in case if we see the stock is dropping to the levels of 1010 or 20 sort of levels, then there we should look for taking positional view on the stock to create some long positions. But at these levels, it is better to stay away.
Yes, interesting development coming in for Tata Consumer as we wait for the numbers. Speaking of numbers, IT giant Infosys is set to release its Q1 numbers while the street is expecting pressure on profitability. What else is on the radar? Let's go to Pulkit to find out.
After TCS, Wipro, HCL Tech and Tech Mahindra, now it's time for Infosys. So if we talk about the expectations from Q1 result, in the USD terms, the revenue could be up around 3%. In INR terms, we are expecting around 2.3% upward movement in revenue. If we talk about EBIT, we are expecting somewhere around 3% up. If we talk about EBIT margin, we are expecting it to be flat, around 21%. And if we talk about profit after tax, we are expecting to go down by around 3.5%. If we talk about the management commentary expectation, we are expecting the deals to be stable, around $2.5 billion. We are also expecting a weak discretionary spending in manufacturing and retail segment clients. We are also expecting the guidance to be maintained, that was around 2 to 5% in the growth, and for the margin part it was around 20 to 22%. Company had given this guidance in the last quarter, so we are expecting that company will maintain this. The key monitorables that will be to watch out for: US business and the BFSI segment business, how it is performing for the company, the deal pipeline and the Gen AI impact on the business, any changes in the FY26 guidance that company had given in the last quarter, what is the outlook on the discretionary spending from the clients, and the most important thing and the last, that is headcount and attrition trend, how it will perform. Once the result will be out, we'll update you.
We do see that TCS has some of the client-specific issues that they will have a more lumpy performance. That being said, TCS valuation continues to look very attractive, and hence there is a downside support in the TCS valuation. That being said, from an outperformance perspective, we think that Infosys could be a preferred pick, partly because of valuation, but more importantly because of the growth outperformance that the company can deliver compared to most of the other large cap peers in the sector. There is a fair degree of uncertainty. A lot of tariff-related deals are yet to be signed, and that continues to elevate the uncertainty, especially in verticals related to retail, CPG, and manufacturing, especially automotive within manufacturing. And hence, those verticals could take longer to start showing any recovery. The good news is that the BFSI vertical, financial services industry, continues to remain quite resilient. Some of the companies even called out that even discretionary spending in that vertical seems to be there.
Infosys will be coming out post-market hours, and we will be putting our eyes on the earnings as well. But one more sector which is buzzing and a strong recovery is coming, that is the pharma sector. And of course, Biocon, Natco Pharma, Abbott India, these stocks have been buzzing in trade as well. Of course, the first quarter itself, it's expected that a large number of exports which were done on a pre-order basis, that's expected to kick in and give a boost to the overall numbers, especially because uncertainty is there when it comes to the tariffs as well. Of course, the announcement coming in from US President Donald Trump was that there could be as much as 200% imposition when it comes to the tariffs. For Dr. Reddy's, the stock is in focus. Their earnings will also be actually coming today as well, and we will be getting a preview on that. But before that, Sudip, how is India's pharma industry decked up? First one, of course, there's a domestic facing angle to it, be it the diagnostics, the hospitals and the generic medicines which are for India exposure. Another pharma stocks is there where there is exposure coming from the global point of view. So how are you looking like the entire India medical space, and which space would be actually attractive in current levels?
Well, as far as diagnostics is concerned, I'm a little conservative here. I'm a little cautious, I would rather say. The companies are doing well. There is a lot of small acquisitions happening. And I think the margins are definitely under pressure and going to remain under pressure in the diagnostic business for quite some time because the competition is intensifying. And because the margins are under pressure, the growth probably is only possible through acquisition. That's pretty much what is we are witnessing. Metropolis went and acquired one diagnostic company, especially focusing on cancer-related diagnostics. And this is more of this probably we will see because that's the opportunity and that's where diagnostic companies will grow. But at this stage, considering valuation, considering the pressure on margin and intensity of competition, including Amazon's entry, I think I will stay put. I will not recommend a buy on the diagnostics. As far as hospital space is concerned, overall, I think it's a fantastic space to be in. There are a lot of action happening here. Global funds, global majors are putting a lot of money in Indian hospital and healthcare sector. And that is leading to a lot of consolidation. The larger players are acquiring smaller players and expanding rapidly. This is a good thing to have happened. And I think, Apollo Hospital, even at current level, does look good from a long-term perspective. And hospital space can be looked at from a long-term perspective, even now at current valuations. As far as pharma is concerned, I think the mood changed when the Trump's announcement came that yes, 200% tariff, but he was going to do it after a lag of 2 years. That's the kind of indication he gave because I think he also realizes the ground reality that putting a huge tariff on pharma products will lead to significant cost inflation and inconvenience for the US consumers. So the pharma tariff is what he's saying is going to come, but it's going to come at a much later date. That led to a lot of excitement in Indian pharma stocks because most of them have significant US exposure. I do like Sun Pharma because I think they, commercialized one molecule and one product much before the anticipated timeline, and that has got a significant potential. So Sun Pharma does look at current valuation. Apart from that, I think domestic-facing pharma companies where significant sales is in domestic market, like a Mankind Pharma, does look attractive even at current levels.
Those are some of the stocks that Sudip is liking from the entire pharma basket. But while we're talking about pharma, all eyes are also going to be on Dr. Reddy's, the third and final Nifty company to come out with its earnings later today. My colleague Shrishti is joining us with what we can expect to see and what the street is penciling in with the numbers. Shrishti.
So when it comes to Dr. Reddy's number, this time around the key to watch will actually be the margins, wherein we are expecting a number of 26.8% on the consolidated front. While in terms of the revenue, that's 8,829 crores is what our expectation is, while EBITDA could be at 2,362 crores with a bottom line of 1,562 crores. But the key to watch and the key to understand is rather what factors could be at play when it comes to Dr. Reddy's earnings. So this time we are expecting the India business to grow by 14% on a YOY basis, while in terms of the North America business, there could be a decline on a YOY basis of 10%. And as we know that for the past several quarters, there has been increasing pricing pressure on one of their key drugs, that is Revlimid, and that can actually weigh heavy. So that's about the expectation on the earnings front. But along with that, within the management commentary that everybody is looking out for is the guidance on the upcoming product launches, and especially some of those product launches with respect to the US markets and the semaglutide opportunity that the company is already working with. And apart from that, the guidance for FY26, where does it stand? That will also be one of the key monitorables, because do remember back in Q4, the company has already guided for a double-digit revenue growth in FY26 to be aided by strong performance across the segments, and they also guided for a 25% plus margins for FY26. So what's new or any update on the guidance front, that will also be that we will be watching out for.
Thank you, Shrishti, for the preview for Dr. Reddy's. But SRF is in focus, a spike coming in, and they would be setting up a production facility to produce agrochemicals at the Dahej plant, and the overall investment would be 250 odd crore rupees. The numbers largely were in line, and we are looking at internals currently, but a good spike coming in the stock. In the last 5 odd minutes, stock is up 2%. Shrikant, volatile counters like SRF and Navin Fluorine, but SRF on the charts, positionally, it does seem like there is a strong numbers coming in. It is at its high levels as well. Would you like to have a much more positional uptick, or there should be a profit booking in this counter?
See, most of the time on the day of the result or after the announcement of the result, we see rally in the stock. This time also I am of the view that the stock is heading for the levels of 3,300 or maybe 3,350, which is its immediate highest level. But I'm not expecting stock to cross this level so easily. So there we can again see some resistance. But for the time being, at current levels, it's a buy. And definitely, if there is any correction after the result, because of any reason, we should look for taking some contra bet of going long, because the overall trend for the stock is very, very strong. Currently, it is at its overbought level, but even at these levels, we are expecting 100, 150 sort of rally from current levels.
On SRF, now let's once again shift focus to the entire banking and financial services group of stocks, because we do have some earnings expected from that front tomorrow. We have insurance major SBI Life will be coming out with their numbers, and also Bajaj Finance. My colleague Varun is here with a poll of both of those stocks and what the street can expect from the Q1 numbers. Varun.
So it would be a low growth quarter for SBI Life, but yes, better than industry, that's what you can expect. We are expecting the overall AP growth to be around 6.1% and the VNB to grow by around 7.1% on a year-on-year basis. On a quarter-on-quarter basis, you might see a decline in both APE and VNB to the tune of around 20 down to around 37%. Also, the key factor to watch out would be the VNB margins, because across industry we have seen last few quarters the overall VNB margins have shown improvement. Even this quarter we are expecting on a year-on-year basis the VNB margins for SBI Life to improve from 26.8% to around 27.1%. Now this is because of the better product mix that the company is giving, and that's the reason the overall VNB margins are expected to increase on a year-on-year basis. But yes, on a quarter-on-quarter basis, the overall VNB margin, they will decline from 30.4% to around 27.1%. Keep an eye on the overall VNB margins and also the growth and distribution through bank channel. This would be some of the key factors that you need to watch on. Though it would be a slow growth quarter for SBI Life, a single digit growth quarter for SBI Life, but yes, the overall performance would be better than industry. See, on growth funds, we are expecting Bajaj Finance to deliver a good set of number, because the quarterly update that the company has given, wherein the overall customer franchise was up by around 21%, the new loans booked, that was up by around 23%, and the asset under management that grew by around 25% and the deposit growth for the company was around 15%. This is the update that the company has given on the Q1 FY26. On the basis of this, we are expecting the NII to grow by around 22.5%, the PPOP that is expected to grow by around 21%, we are expecting 8,420 crores, and the profitability that is expected to grow by around 18.8% to around 46 crores. Now, if you look at the overall performance of the company, no doubt the asset quality that is expected to be stable, but yes, the overall net interest margin that would contract by around 5 to 10 basis point, and this has been a trend across the BFSI sector. So this trend would continue for Bajaj Finance as well. On the quarter-on-quarter basis, if you look, the overall spreads, they are expected to be stable at around 8.5% as the yield pressures on mortgages will be offset by the low cost of borrowing. We expect the overall results of the company to be stable, the growth would be good, asset quality would be good, but yes, keep an eye on the net interest margin and also the commentary on the net interest margin going ahead, what could be the trend. But this quarter, the net interest margin could contract around 5 to 10 basis points.
Okay, so those are the street expectations from Bajaj Finance as well as SBI Life, and of course you have Nestle also that will be coming out with its earnings in the market as tomorrow. Decent set largely is what we're expecting from Nestle this time around. But as we start winding down for the day, Shrikant, just a final take on where do you expect our immediate levels to open tomorrow, given it's the expiry tomorrow? What do you think our trading session could look like, in any review on where the Nifty could open tomorrow?
See, for Nifty, it is in the range. It has been consolidating since last almost 7-8 days, and after hitting the important levels of 24,800, 850, we saw a decent recovery in last 2 days. So I am of the view that 25,300, 350, where the market is having resistance of 20 days simple moving average, is going to act as major resistance. There we may see some pause, but there could be a very high probability that the market may open somewhere close to 25,300 sort of levels, and then later on again we may see some consolidation. But the formation of last 15-20 days suggesting us that the market is heading higher towards the levels of 25,500, and it has completed its correction. So in case if there is any correction because of any reason, if there is any lower opening, we should look for taking some long trades in the market.
Okay, gap up opening, will there be a gap up opening, or any global cues might suggest and give a different story? Sudeep, of course, FMCG space we spoke about, but the new age tech stocks, that has been important discussion, and we have seen a strong earnings recovery coming in when it comes to the likes of Eternal and Paytm as well. How is the market actually now valuing a new age tech company, and the class of 2021 is actually blossoming in 2025 as well, and a lot of large tech IPOs are also expected to come in this year as well. So how are you valuing this new age tech space, and which would be the winners here?
Well, I think a lot of maturity has come in this entire space. When 21 the issues came, many of the promoters were talking that profitability is not their goal. I mean, they're not budgeting in, penciling in profit as a factor. Now that realization has come in, that's extremely important, and I think all of them have learned their lessons and fine-tuned their business and fine-tuned their the entire operation to ensure there is a profitable growth, or at least there is a visibility of profitability. That's a big change. And post that, I think market has started looking at them and in the right spirit. So, I won't talk about Paytm too much, but let's talk about PB FinTech. I think that's one business which is, roaring, and the scope for that is significant. It's insurance distribution is such a huge space, and the opportunity is so huge. And, they have been able to capture quite a large chunk of that, and I'm sure going forward they will continue to do well. In between, the unrelated diversification of investing in a healthcare company raised some concerns among the investor, but I think that has been to a great extent put to rest by clarifications from the promoter group. So PB FinTech does look good. Eternal, of course, I think the quarterly numbers were pretty good, I would say, because more than profitability, it's a revenue growth which is extremely important, and both in the food delivery segment as well as the quick commerce segment, I think they have been really focused. The district and the other segments that are still in a nascent stage. But both food delivery as well as Blinkit, they're rapidly growing, gaining market share from competitors, and that's what the market likes. While profitability has come down a bit, but I think long-term growth is what is most important for these kind of platform companies, and that's why market likes it. So I think I would say that between Eternal and PB FinTech, both can be looked at if somebody has a long-term
Right.
time horizon in mind.
Right, Sudip, thanks for that view. And Sudip and Shrikant, thank you so much for joining us. Just on the paucity of time, we'll start wrapping down for the day.